The stock market has been having a rough go of it lately. As I record this video, the Nasdaq has crossed into correction territory, which means a drop of at least 10% from its peak, and the S&P 500 isn't far behind. Here's the thing. When things get rough, it's easy to start questioning if it's time to sell. I'll give away the ending of the video right now. Don't do it. Let me show you some of the math behind the decision so that you can have a good frame of reference to remain level-headed in times of market turbulence. So the first chart that I want to show you comes from the JP Morgan Guide to the Markets. What we're looking at here is the bars showing the return of the market each year. This is the S&P 500 over the last 44 years. And then that little red dot down below the bars shows the largest decline at any point during that year in the market. So while you can see we've been up 34 of the last 44 years. Those have been positive years in the market. In every one of those years, the market has been down at some point, and in 27 of those years, it's been down more than 10% at some point during the year. Even in a good year, 27 out of 44 years, a drop of at least 10%. So this is far from out of the ordinary. In fact, it's actually quite normal market behavior. Market corrections are a normal part of the market cycle, and while it's never pleasant while it's happening, history shows us that even in the good years, there are drops during the year, and more often than not, those drops reach really painful levels. As I say regularly, market volatility, the painful drops that come along with investing in stocks, are the price we pay for the gains that we get. I'm going to give you another comparison, another chart. This chart comes from Visual Capitalist. It shows us the growth of $100 from 1970 to 2023. Now, every now and then I get questions from clients about whether we should be moving to cash, if we need to get out of the market, and I talk to them about something like this. So while we just talked about what market volatility looks like with all of the red dots on the previous chart that showed the down times, this chart shows the impact of the positive side of things, of being invested over all of those years, of the gains that you receive. So over this time frame, the S&P 500 turned $100 into $22,419. Put a couple more zeros behind that. $10,000 invested in 1970 in the S&P 500 would have turned into $2.2 million. That's some serious money. Meanwhile, cash over that same time period, measured by a 3-month treasury, would have turned the same $100 into $956, or $10,000 into a little more than 95 grand. That's not to say put all your money in the market. I've said it many times before, different money has different jobs, but for your growth money, your future money, and even folks who are retired should have some future money. Don't treat it like a short-term investment. Don't put it to cash, even when it's painful to watch the stock market decline. Now, the right answer here, the ideal answer, is to make sure that you're allocating money appropriately, that you don't have too much in that growth bucket to begin with, and then you can remind yourself of why it's there in times when it's painful to be there and feel maybe a little bit better about it because of the structure of your plan. It helps you stay the course. Now, on to the next reason to stay the course, trying to time the market, trying to pick when to be in and when to be out. Historically, it just doesn't work. Remember, we're investors. We're not traders. Trading stocks is something that you should not be doing with your nest egg, getting in and out. This chart shows you why. So this is a chart showing returns from 2003 to 2022. But if we looked at something beyond those dates, it's still going to be a similar story. So here we can see that $10,000 invested over that time for the entire time turned into $64,844. Assuming 250 trading days per year over a 20-year period, that basically includes 5,000 days of stock market returns. Now, what happens if we just pull out 10 days, 10 of the best days of the 5,000? Your return drops to $29,708. Put another way, you go from averaging 9.38% per year, a very nice return if you stayed invested the whole time, to only 5.46% without just those 10 days out of the whole 5,000. That's almost half of your entire return over a 20-year period determined by 10 days. Here's the kicker. 7 of those 10 days happened at a time when stocks were in a bear market, meaning they were dropping, the market was down, and it was a time when people were running for cover because the market's down 20+%. Nobody wants to be invested then. That was 7 of the 10 best days, and if we take those days out, you can see that it wrecks the return. As you can see, if it got even worse, missing more of the best days hurts returns even more, to the point where if you somehow had the terrible luck of missing the top 40 or more days out of those 5,000, well, you might as well have just kept your money in the couch cushions, because you would have actually ended up with less money than you started with 20 years earlier. This is where the saying comes from. It's time in the market, not timing the market, that matters. You gotta stay invested because you don't know when the best days are coming. Now, to the point that the best days are coming, one last chart for you today, and one last reason to stay invested. History has shown us, going all the way back to the Great Depression, that after market declines, we've historically seen good markets return. Now, to be fair, this chart is measuring bear markets, drops of at least 20%, not corrections, which are drops of 10%, which is where we're at right now as I record, but the same holds true. Following bear markets going back to 1980, we've had market returns in excess of 300% in the following 10 years in each of the three instances that that's happened. And measured from the COVID drop and from 2022, we're back into positive territory already. Remember my last point. You don't know when the best days are coming. If we peeled some of the best days out of these figures, they would likely tell a much different story. You've got to stay the course. Now think about that for a second. Think about the saying, stay the course. When I say that, I picture a ship encountering really rough seas. It's getting tossed back and forth. The winds are howling. Sheets of rain are being dumped on it. And they stay the course because they know that to get to their destination, turbulent waters can't stop them. They have to press on. And that's the point. As I said earlier, sometimes to invest well, you have to fight your human nature. You have to remove the emotion from the investing process. You have to stay the course in rough waters. And while it may not be pleasant, you can't allow the winds to howl and to blow you off course. All of the math in this video, all of the charts are just a reminder that going back nearly 100 years, all of the data tells us to stay the course. Now, I gave away the end at the beginning. You're not supposed to do that on YouTube. None of this is exactly a hot take, but I hope that it serves as a reminder to you to stay the course in times when things get bubbly like this, in times when it doesn't feel good to invest, because in the end, investing should be a logical undertaking, not an emotional one. And sometimes that means we have to fight against the natural human emotion in order to invest successfully. Now, all of this is easier when you have a proper plan in place, when you're giving the right jobs to the right pieces of money. I mentioned just a bit ago, making sure that you're allocated the right way to begin with, and that allows you to better withstand these times. We do that by using 3 bucket plans for our clients approaching or in retirement. If you're interested in seeing what that looks like, I got you covered. Check it out right over here.